So earnings season has kicked off and we're seeing some big moves in stocks that we typically don't see a lot of movement in. It's kind of, flipping everyone's perspective here, and it's kind of doing the opposite of what everyone's expecting. For example, Google had an amazing earnings. The stock is moving massively, but you don't typically see this with Google. And on the other side, you have Tesla, expected to move massively, but remain relatively flat. And the stock market, guys, just continues to surprise us. And today was no different. We had plenty of stocks today down 10%. And this is not something you see that often, especially when the market is pretty much pushing new all-time highs pretty much every other day. Pinterest is down over 14% here after reporting earnings last night, and it seems like they're getting punished for not quite meeting investors' expectations. ENPH, a popular energy play here, especially on YouTube, is also down a little over 14%. Spotify reported their earnings this morning and is down over 11.5%. So what in the actuality is going on? Why are these stocks seeing such massive hits when the market as a whole, the broader market, just keeps chugging along higher? I think that it has something to do with the investors kind of thinking that this is a risk-off environment. They're moving kind of away from these high growth plays that did phenomenally well in 2020, especially businesses that aren't really making any net income yet. They're kind of hands off of those right now. A lot of selling has been going on with those kind of stocks, and it started back in March, and some of them are still pretty much near their lows. They have not recovered like a lot of us were expecting, and it seems like the money from those stocks has kind of started to flood into safer companies like McDonald's, Visa, Amazon, these kind of plays. This is why, in my opinion, it always makes sense to have a balanced portfolio, have exposure to good businesses in different industries, because when some of them hurt, the others are going to do really well, because that money typically flows from one to the other, and overall your portfolio will probably still keep going up over time if you've allocated properly. Now here's the thing, with this huge sell-off with some of these stocks, it only matters if you're day trading or you're on short-term options or just kind of speculating on these plays. If you're a long-term investor, these are welcomed opportunities to build up positions. I can't stress that enough. Maybe we go through a period now for a few weeks or a few months where these stocks, these high growth plays, just continue trending lower. Every week it loses 1% or 2% and just keeps going lower and lower and lower. And before you know it, it's down 40, 50, 60%. That's possible. But guess what? As long-term investors, all we have to do is, when we find these incredible businesses with strong fundamentals, we just keep averaging into them, guys. And you know what? That's exactly what I'm doing right now with this position, Spotify. This morning I actually picked up some shares at $262.50 after this juicy 10% dip after the company reported their earnings. And the reason I bought more Spotify is because I believe this is a huge overreaction from Wall Street. I believe the stock should not be down double digits today. In fact, it should be up double digits, if anything, because when you kind of peel back the layers and look at the actual data they reported, this business is still doing phenomenally well. So look at what Spotify actually reported. They beat on EPS, and this is a good sign for a company working towards profitability, and they met expectations for revenue, but revenues here grew 16.2% year over year, which is a good growth play. Gross margins also came in strong at 25.5%, but the disappointment was with their monthly active users, which missed estimates. It came in at 356 million versus 360.4 million expected. But again, these were kind of the facts that some people read. Some people only read the headline, didn't even look at monthly active users, and that's not really doing due diligence. But let's peel back the layers a little bit and look deeper. Spotify saw phenomenal growth across both premium and ad-supported users. Premium subscribers increased 21% year over year, ad-supported increased 27% year over year, and the total monthly active users, although it missed by 4.4 million, it still increased 24% year over year. This has also led to massive increases in revenue from ad-supported users of a whopping 46%, which contributed to positive free cash flow of 41 million euros versus 21 million last year. So year over year, this company is doing phenomenally well. They're still a very strong business. The fundamentals are still extremely strong, still intact. Everything looks good, but the stock's dropping and I'm buying. Sure, there could be an argument being made that, hey, Spotify is not profitable yet, so it doesn't deserve, a $50 billion market cap today. I tend to disagree with that because I think this company is well on their path to becoming profitable. You can see they have positive free cash flow right now. And sooner or later, the market will come to realize this. And that's when I think we'll see a big rally in the stocks. So I want to build my position here before that's kind of realized by the general public. What I really like about this business is that they have customers from all over the world. You can see it's fairly split here. And this makes them a very global company, global brand with a global presence. And as an investor, it's a global opportunity. But because they're global, because they're based in Europe, it comes with a little bit of a downside sometimes. Currency fluctuations does affect them. And in this quarter, it did have a big impact on them because revenues came in at 16% year over year versus 22% if things remained constant. So there is a little bit of risk factor here when you look at Spotify when it comes to the, currency risk. But guys, all things considered, over time, I believe that this will probably just balance itself out. And what we can still focus on is like the core fundamentals, the growth metrics of the company. Now, guidance for 2021 looks strong. They expect monthly active users to climb by over 50 million users, which is a very positive sign of continued momentum and adoption. This should lead them to nearly 10 billion euros in revenue. But again, this could vary depending on currency fluctuation. Overall, I think this was a pretty darn good earnings. Sure, they missed on monthly active users here, and that's probably why the stock got punished. Companies like Netflix or, Snapchat or Facebook, these kind of companies, analysts and investors look at the monthly active users, daily active users. Those metrics are typically the most important metrics, and number of subscribers, that kind of stuff, as opposed to like their net income or free cash flow or their revenues or EPS or anything like that. That kind of stuff is secondary to these, subscriber numbers. And hey, I'm sure there's going to be a case made out there for a justification for this double-digit drop today, but in my opinion, I think it's overdone. Now, the CEO of Spotify was also on CNBC this morning and discussed their new podcast subscription venture that they're working on. And he said that they are in growth mode here with heavy investments. So we probably won't see, too many results from this anytime soon, but he thinks this will end up being a stronger part of the business over time than their music streaming business. So there's definitely some exciting stuff going on with Spotify behind the scenes. They are building out different revenue sources. They are focusing on things outside of just pure music streaming. There's also speculation that maybe they'll buy Clubhouse at some point or something like that. That could be a good addition to their portfolio as well, because that'll kind of put them into like the social media presence, and it opens them up to more users overall. But regardless, I think even as a standalone platform right now, Spotify is incredible. Now here's the current chart for Spotify, and it did break through the 50 moving average on the weekly, and that was a good level of support for the stock. So we'll have to see if it comes down or test the 100 moving average, which is that orange line at around the $230 mark. The good news though is the stock is still very oversold, so we could see a reversal fairly soon, especially if the broader tech market and high growth market starts to recover. It'll probably pull Spotify up pretty nicely with it as well. So as per my strategy, I will continue dollar cost averaging in. I like what I saw from this earnings report. I have no doubts with this company long term. It's a good business. The metrics are good. The growth is good. And at these suppressed prices, under $50 billion, I think for me, it's an incredible buy. Anyways, guys, hope this video was useful. If it was, hit the like button down below and subscribe as well if you're brand new here. Anyways, thank you so much for watching. Don't forget to invest positively. I'll see you in the next one. Peace.